Now, let's move on to the second one. The second one is about deductions. Earlier, we deducted items that didn't involve cash outflow, but now we're talking about items where no cash actually came in, yet they're recorded as profit in the income statement, so we need to deduct those as well. That's exactly the opposite concept. So the most representative example of this is what's called fair value evaluation gain. I explained this concept last time as one of the factors that creates a big difference between operating profit and net profit on the income statement. Or if you don't quite understand this concept, I think you can get a better grasp of fair value evaluation gain by watching the previous Mijuchu video. So to explain this a bit, what fair value evaluation gain means is this fair value. In English we call it fair value, but actually it's not really fair value. It's more accurate to call it market value. So the way this is evaluated is about how much it's currently valued in the market. That's what fair value means, you could say. So I think it's actually closer to the concept of intrinsic value, but since this is the term that's used, there's nothing we can do about it. It's called fair value assessment, but I think it's right to look at market value. The profit that appears on the books just depends on how much the market values it. To put it simply, for example, it's like this. If the fair value of the stocks a company holds goes up, it means the stock price of the shares they own has increased. So, because the stock price went up, there was an appraisal gain of about $200 million. Then, what happens to that $200 million gain? It gets reflected as non-operating income on the income statement. So, one of the factors that makes net profit larger than operating profit is this fair value gain, as I mentioned. That's why the profit is reflected on the income statement. But in reality, since they still hold the stock, this $200 million hasn't actually come in as cash. It's just an appraisal gain. For example, if you own NVIDIA stock and you've made a 50% profit that's just an appraisal amount, this is what fair value appraisal means. If it drops by about 20% a day, that profit can decrease at any time. You have to actually sell it for cash to come in. When you're just holding it, no cash comes in. But anyway, since there's an assessed value, it has to be recorded on the income statement. That's called fair value assessment, and it's included in the income statement even though no cash has actually come in. This is income without any cash inflow. This is the most typical example, so it needs to be excluded. So the fair value assessment amount, which is non-cash income mentioned earlier, should be excluded to properly match the cash from operating activities. The first one, depreciation expense, is money that hasn't actually been spent, but it's counted as an expense, so we add it back. On the other hand, valuation gains are profits that haven't actually brought in cash, but they've been added to the income statement, so we subtract them to properly match the cash flow. This way we're getting closer to the actual cash flow. So this is the second concept.
That's what it is. This too.
One by one, even the law is easy to do. Another kid again.
Working at the hotel helps a bit.
Since there are various facilities and types of phones there, after all.
That's right. Besides investing in stocks, there's a more interesting example. Have you ever been to a wedding fair, Chief Executive Officer? You know, things like wedding expos. Hotels often hold wedding expos or wedding fairs once a year. So, especially in the case of larger hotels, there are some that host 200 or even 300 weddings a year. So for those hotels, wedding sales are really huge. So in order to take a lot of reservations at once, they hold wedding fairs. For example, let's say they hold a wedding fair for a day and get 120 reservations. Then all the cash received from those 120 wedding reservations would be included in the cash flow statement, right? As if they made money right away. But actually, these weddings aren't all happening on that day. Over the next year, for example, there might be 10 weddings in January, 8 in February, and maybe 30 in April because the weather is nice. So the reservations are spread out like that. So actually, in the income statement, the sales need to be recorded in the month when the wedding happens. That way, the revenue matches the expenses since the service and food are provided at that time. This is how the income statement is properly calculated. Even though all the cash is received on the day of the wedding fair, the actual net profit and sales are recognized gradually each month like this. So, When we later calculate the cash flow from operating activities, there is no actual cash flow at that time, but the income statement still recognizes it as sales. Since this sales amount was already included in the cash flow when the wedding fair happened, we need to subtract it. I think you'll understand it more easily if you think of it this way.
So,
Right now, the wedding.
when we receive money in advance for a wedding, we call it an advance payment. We record the amount as an advance payment and it is listed as a liability on the balance sheet. Then, as you mentioned, when the actual wedding takes place, we take that amount out of the advance payment and recognize it as revenue on the income statement. So companies with a lot of advance payments often experience situations like this. If they have advance payments, they're not just going to keep the cash in a safe. If they invest this in bonds again, or at least buy government bonds or put it in the bank, they'll earn interest from it. But since advance payments are actually liabilities, if a company has a lot of them, its debt ratio looks really high when we calculate it, so it can look like a risky company. This is typical in industries that receive a lot of orders. For example, Korea's shipbuilding industry and large construction companies that handle big projects receive a lot of advance payments. Projects that handle everything from design to supervision all at once, like those that build petrochemical plants, definitely receive advance payments because they secure contracts in advance. So if the amount of advance payments increases a lot, does that mean the company's debt ratio is high and it's risky? But actually, for those multi-trillion won projects, if you want to spot them early, the advance payment ratio is maximized. So when the debt ratio is high, that's actually one of the hints to find these companies before their sales explode later. As I mentioned, when we look for early stage growth companies, we find hints through their operating cash flow. For order-based companies, the way to spot them early is when their advance payments suddenly surge compared to usual. In reality, this is the early stage when they are going to make a lot of money in the future. At that time, their financial statements might not look very good. Since they're order-based companies, their profits may not be high, and because order-based industries are typical cyclical businesses, they could even be close to running a deficit. If you connect those points, well, as I mentioned before, looking at the financial statements is like looking at the company's business activities. If you keep matching those things and practice looking at the account titles and keep thinking, if they do this activity, what will change? And keep making those connections, then your perspective on reading financial statements will broaden much more, and your understanding of the news will also become much broader. Actually, what we're covering now is elementary school level content.
But, Mr. Chief Executive Officer,
Gave us another good example, so I mentioned it. The last one,
Branch comes all the way here.
and we'll take a look at an actual cash flow statement and wrap things up. Changes in working capital. That's what this is. But first, this term is really difficult. In Korean, it's unjon jabon, working capital. But what does unjon mean here? Is it driving or is it something else? The Korean term is based on Chinese characters, so it's pretty difficult, but I'll explain this part quickly. It's much easier if you look at it in English. It's easy in English, but when you see it in Korean, it's really difficult. Operating capital. Does it mean the capital needed to run a company? It's similar, but if you look here,
It says working?
you know, it's the funds used to operate a company. That's the concept. In Korean, that's called unjon jabyon, or working capital. To put it simply, it's the operating funds used for day-to-day business activities. This refers to the money needed for the cash that goes in and out of a company, mainly for activities related to its main business. We call this working capital. So, to explain, you might have seen the screen below before as well. When I was explaining the balance sheet, I showed you this while explaining what inventory assets and accounts receivable are. If you still don't understand this explanation, I think it would be good to go back to the balance sheet and take another look at accounts receivable and inventory assets. We're studying the cash flow statement right now, and this records the process of the company's cash going out, coming back, and returning to cash again. So, when this cash comes back after making a round, the more it returns as a larger amount, the better we can say the company's cash generating ability is. Let me show you how the company's cash is converted, as recorded here. When a company first wants to make a product with cash, it has to buy raw materials, right? So it buys raw materials, but just because it bought raw materials doesn't mean it pays cash right away. Usually, after the company selling the goods issues a tax invoice, the payment is typically made in cash within about 30 or 60 days.
That's standard business practice.
There's a time gap that occurs, right? I bought raw materials, but I didn't pay for them for a month. So I have more raw materials, but I also have a debt for something I haven't paid for yet. So this is called accounts payable. In English, it's called accounts payable. Payable means there's money you have to pay, and debt means you have an obligation to pay it back. Purchase means you bought something. So, when you buy something, you have an obligation to pay for it. To put it simply, it's like the old-fashioned store credit we used to have. Store credit is basically the same as accounts payable. That's how you can think of it. I take the goods now and pay for them later. I already have the goods with me.
This is the difference.
That's what happens. So, this is how accounts payable occur. This is the money that goes into a company's basic activities, like buying raw materials, making products, and selling them. All of this money is called working capital, and accounts payable is one part of it. The second is the process of actually making products after buying the raw materials. I've put a box around this, but you can just think of work in process as something you don't really need to remember. Just know it's there and you can forget about it. This isn't an account title you need to memorize. Work in process just means it's in the middle of production. The word "je" means to exist, and "gong" refers to the process, so it means it's in the processing stage. So you're making something with raw materials, like assembling an iPhone, but the assembly isn't finished yet. Then December 31st comes. What do you call this? Since you've already started working on the raw materials, it's not considered raw materials anymore. But it's not a finished product either, so it's not a product yet. All of these are called work in process. So, if we compare it to adults, it's like kids going through puberty, those who are in the middle stage right before becoming adults. So, there's nothing much to analyze here. You just need to understand the concept for now. So, the period from buying the raw materials to producing the product is what I refer to as inventory assets. This inventory asset covers the time from purchasing the materials to making the goods. If you ask how many days this takes, I said we attach the number of days to it. So if we add what's called the turnover days here, it becomes inventory turnover days. Inventory turnover days means how many days it takes from buying raw materials to making the goods. So, the lower the inventory turnover days, the more likely the goods will move out much faster. That means if you make things quickly, there's no time for inventory to pile up and everything speeds up. So I mentioned that inventory turnover days is also a very important indicator in the manufacturing industry. Lastly, after producing the product, you sell it, right? But when you sell the product, you don't get cash right away. Just like with accounts payable earlier, it takes some time before you actually receive the cash. During that time, what do we record it as? We record it as accounts receivable. This is called receivables. So a receivable is the right to receive money, and sales mean that you sold the goods. In other words, you sold the goods but haven't received the money yet. So the account that occurs during this period is called accounts receivable. So these three, accounts receivable, inventory assets, and accounts payable, these three make up working capital. Accounts receivable plus inventory assets plus accounts payable, these three are what make up working capital. There are companies that need a lot of this. For example, let's say there's a company where it takes about 100 days to collect accounts receivable. Let's say a company sells goods, but it takes about 150 days to turn inventory into cash, and it takes about 30 days to pay off accounts payable. If you look at how many days of working capital this company needs, if you add those two together, it's 250 days. First of all, this much money is tied up because it takes 250 days for cash to go from start to finish to complete one cycle. So it means you need to have at least 250 days worth of cash on hand. So the longer this period is, the more cash flow the company needs to keep things running. The shorter this period is, the better the cash flow turnover rate is. But what is accounts payable? It's what I have to pay back.
It's money that I have to pay back.
Because it's money I have to pay back, I don't need to have that much cash on hand. So this one has a negative sign, so it's plus plus and then minus. So in total, this company has about 220 days of working capital turnover, which is also called the cash conversion cycle, and that's the indicator we're talking about here. The cash conversion cycle, also known as the number of days cash is turned over, refers to this. To put it simply, it's the number of days it takes for a company to buy raw materials, make products, sell them, and get the cash back. So the shorter this period is, the less working capital you need and the more advantageous it becomes. If you've understood up to this point, I'll wrap things up here and move on. So why do we record the increase or decrease in working capital in cash flow as a positive or negative? Let me explain this concept. Let me give you an example with accounts receivable. Last year, accounts receivable was 10 billion won, but this year it's 5 billion won. So that's a change in accounts receivable, right? It decreased by 5 billion won. Does that mean cash came in or went out? Since cash came in, the accounts receivable decreased, right? So, since we define accounts receivable as sales for which we haven't received cash yet, if accounts receivable went from 10 billion to 5 billion, it means we received 5 billion in cash faster. In other words, cash came in. But since the sales have already been recorded in the income statement as accounts receivable, it's already counted as sales there. So there's nothing you need to adjust in the income statement. Simply put, a decrease in accounts receivable means there's no change in the income statement, but it just means cash came in faster. So, if accounts receivable decreased, or if the amount for accounts receivable was negative, that means cash came in. So you need to add that amount here. On the other hand, if accounts receivable increased, it means cash is tied up. So you need to subtract that amount from cash flow. It's the same concept for inventory assets and accounts payable as well. So although changes in working capital aren't actually items on the income statement, when working capital increases, or when you pay out cash later, or as you can see here, when you pay out cash later, receive cash faster, or process inventory assets more quickly, these movements affect cash flow. When less cash goes out and the company's cash flow improves, that's what we refer to as changes in working capital. That gets recorded as a plus or minus in the cash flow from operating activities to balance everything out overall. So through this, we calculate the overall cash flow statement. I think that's the basic concept you need to understand for now. Next, I'll show you a cash flow statement from our website. And then we'll wrap up. It's a bit of a difficult concept, but if you listen carefully and take your time, I think you'll be able to understand it. You can see the screen, right? Yes.
I can see it clearly.
Advanced micro devices. It's advanced micro devices whose stock price is doing really well these days. And back when we did the return battle, Chief Executive Officer Min Joo-un picked her top pick. And for my top pick, I said this stock seemed really good. Looking at the data, fortunately, it went up a lot, which is a relief. If you go into the financials here, if you look at the financial statements, there's the income statement, the balance sheet, and at the very bottom, there's the cash flow statement. The cash flow statement is the shortest one. It's brief. As you can see here, I told you there are three things. You just need to remember these three. The part called capital expenditure that I mentioned earlier refers to the capital expenditure that the Chief Executive Officer talked about, and this amount includes investments in tangible assets and things like that. If you look here, Advanced Micro Devices has three types of activities: operating activities, investing activities, and financing activities. So if we interpret this, what we can say is that this is based on an annualized standard, based on the sum of the most recent 4 quarters. As of March 29, 2025, Advanced Micro Devices is generating about $3.4 billion in cash flow from its main operating activities. That's the concept here. And they're spending $1.3 billion for future growth. In financing activities, it's a negative number, which means money went out. So you can interpret it as about $260 million being spent through financing activities. So the total of all these amounts is the change in cash shown below. When you add up operating, investing, and financing activities, that's how much cash increased this year. So in the case of Advanced Micro Devices, the cash flow increased by about $1.8 billion. If you compare this trend to recent times, it's a huge change. An enormous change has occurred. And above, the cash flow from operating activities is $3.4 billion. Let's take a look at the net income. If you look at the net income, it also increased sharply, but it's $2.2 billion. Then there's a difference of more than $1 billion, about a 50% difference. So why does this difference occur? Then, as I mentioned earlier, if you make a lot of investments, depreciation and similar expenses tend to be recorded in larger amounts. If you substitute those, since business activities have grown, as tangible and intangible assets here decrease, depreciation expenses will continue to decrease, and as depreciation decreases, net profit will increase accordingly. So even if sales don't increase, but this company is currently growing its sales extremely rapidly, so it's a completely different case. I'll just click it once for the quarterly view. So in recent quarters, I mentioned that analyzing the cash flow statement is useful for discovering early stage growth stocks or similar opportunities. If we look at the cash flow statement on a quarterly basis like this company made about $400 million, $300 million in the past, and it also did well in 2023. If you look at it, the growth rate from here jumps quite a bit. 590 million, 620 million, 1.29 billion per quarter. So compared to the past, their cash flow generation ability has increased by about 2 to 3 times. So if there is a change in this part, it's very likely that changes in the income statement will happen sequentially. Then, how do you check if the income statement will continue to do well in the future? You can check the consensus in the overview at the very beginning. So by checking the consensus, you see that sales are expected to grow by 22% this year, 17% next year, and 14% the year after. Earnings per share is expected to grow by 87% this year, 88% next year, and 34% after that. That means the growth rate of earnings per share is much faster. So, since both sales and profits are expected to increase, profits can catch up quite quickly in terms of cash flow, which means that the improvement in rankings could appear quite rapidly. So companies that show this kind of pattern, I've told you that companies that are just starting out as future growth stocks tend to appear in a sort of triangular shape. As this company grows, it's also filling in its monopoly and gradually increasing its profit margin. So among growth stocks right now, NVIDIA is the only company that appears as a pentagon. NVIDIA, when I look at it, I wonder if there will ever be another company like this in the future. It's a growth stock, but it's a company that's completely filled out. But right now, Advanced Micro Devices is starting to fill out and is trying to resemble that. If the profit margin keeps improving from here, it could become like that. So I think it's one of the companies worth keeping an eye on. So I'm not recommending this stock right now, but I'm saying that if you look at it from a cash flow perspective and use these methods, you can find some good companies. With that, today's cash table,
I can wrap it up for you.
today as well.
That's really useful information. You must be a bit tired, but can I ask you one question?
Yes, today.
There were several things we learned today, but I think the term that is most relevant to the viewers of this broadcast is probably depreciation, because like me, many of the Mid-Year family members are investing heavily in artificial intelligence beneficiary stocks. And among them, there are a lot of mega tech companies like Amazon, Meta, Google, and even though it's not a top pick right now, Microsoft as well. These companies have poured an enormous amount of money into GPU investments. So when they buy GPUs, as I explained earlier, this amount goes into CapEx, not operating expenses. They must have bought these GPUs as CapEx, and we're talking billions of dollars. But eventually, all of this will come back as depreciation expenses. So since they've already spent a lot of money since last year, can we see how depreciation is changing for these companies and what kind of impact it's having on their cash flow? For example, how is it for Meta?
Can you see it? Yes, I can see it. I'll go in and take a look. Let's see how much has been invested so far and check things out. This is the current quarter. Let's look at it on an annualized basis first. We'll check it annually, and let's start by looking at the cash flow statement together. The cash flow from operating activities has almost doubled over the 2 years compared to June 2023. So, as it increased from 5, 6, 6, 7, 8 to 9, it's a case where things have improved significantly. Now, if we look at investing activities, wow, that's amazing. When looking at things like this in the past, when looking at time series, It's very important to identify the specific point where things changed dramatically. And at that point, if you open the original electronic disclosure, you'll find notes about where they invested and other details. What you're looking at here, as I see it, is that we have $30 billion, then $29 billion, and then $25 billion, which means that assets from investment activities are continuously decreasing due to depreciation. It was a stage where they weren't making additional investments.
Again.
If you look at when it starts to increase again, from this point on, I'll explain the meaning of plus and minus signs next week, but for now, minus means money is going out. So, $26.4 billion went out in investment activities, and if you look here, $29 billion, $32 billion, this is the highest right now, you can see it clearly. If you look at it this way, starting from $20 billion by September 2024, based on the year-end figures, it totals $32 billion, then $47 billion. This was an enormous investment at that time. They invested almost 30% and then invested another 20% again. In just 2 quarters, investment activities accounted for over 70%. These investment activities can be largely divided into 2 types. One is investing in tangible assets, and the other is buying stocks. So, even though they made these investments, if they bought stocks, it's more for financial management rather than for the future. So we need to look at it differently. We need to see whether Meta actually invested in real facilities or not. To do that, we need to see where the money was spent at that time. So I mentioned in the first and second sessions that we need to look at the balance sheet. So now all of this becomes important. So let's go up and take a look. The balance sheet shows where the money was spent, so the total assets are now $280 billion, and the largest portion is tangible assets, which are about $150 billion, so that's almost 50%. Simply put, in the case of Meta, they've put 50% of their total assets into tangible assets. To put it simply, it's like if you were investing in stocks and you bought 50% of your total assets in NVIDIA stock. That's basically what this means. That means if NVIDIA doesn't go up, your portfolio won't make any profit. It's the same thing. What this means for a company's balance sheet is that if these tangible assets don't make money, Meta can't make money either.
That's what it means, and if it goes well.
If it makes money, it hits the jackpot. That's what it means. So, if you look here, the proportion itself means that about 50% is being invested, and you just need to see how this ratio has changed. If you look here, as of June 2024, it went from 110 billion, 120 billion, 130 billion to 150 billion. So it reached almost $150 billion. That means about $50 billion have been continuously invested here. Since tangible assets themselves have increased by 40%, now it means the money was indeed put into tangible assets. And if you look at short-term investments here, they did increase a little, but it's nothing compared to the increase here. So you can see here that it's true that a significant part of the actual investment activities was put into facilities. So the balance sheet isn't meaningless like this. So when you look at this, you might wonder what exactly is increasing and by how much within tangible assets. You can find all of that in the notes section by opening the electronic disclosure on electronic data gathering, analysis, and retrieval. Using that, you can analyze things a bit more rationally. Just by looking at these figures, you can confirm that it's true they invested in tangible assets. The next important thing is whether they will make money from tangible assets. The question is, will Meta make money? To make money from these tangible assets, it needs to be connected to revenue. These are the 2 points that need to be linked. This is one of the indicators I mentioned at the beginning of the show, tangible asset turnover. It shows whether these tangible assets are connected to sales. If this indicator is maintained or recovers, and I probably gave an example comparing Micron Technology and Intel. So, Micron Technology made a big bet on investing in tangible assets, and now it's entering a phase where those investments are connecting to sales. On the other hand, Intel is in a declining phase, so you can see the 2 companies differently. Meta is the same as well. If you think about it, even if you make this kind of tangible asset investment now, it doesn't immediately show up as sales in the next quarter. There will definitely be a time lag, but this ratio, the sales divided by tangible assets, will probably be low right now since they've increased the denominator, the tangible assets, a lot. But once the construction project is finished or sales increase, it will stabilize again. This stabilization or the ratio going down can be seen as an indicator that the company is moving towards selling its products well. So, in that case, we can only see it after it happens. That's when consensus becomes necessary. So for these tangible assets, our standard is $15 billion, right?
You mean $1,500.
Let's remember that number and move forward. This looks like it's about the level of Miju High School. I think it's about Miju High School. Let's take a look. So here, the sales revenue for 2024 is $150 billion, and the sales revenue is $160 billion, right? So that's about 1-to-1, right? Next, if you look here, it's $150 billion to $180 billion, and then for 2026, since 2025 is already halfway over, soon investors will probably start looking at the 2026 results. Since about $210 billion is expected, if you divide $210 billion by $150 billion, you can see that the efficiency is gradually improving. Tangible assets are staying the same, but through the projected results, we can see that this is increasing in sales, which tells us that the indicators are recovering. So we can see that Meta has made a large-scale investment, and the indicators for this part, like earnings per share or sales revisions, will be adjusted in the future. So if these get revised upward little by little, the market will probably see it as a much more positive signal. Then I think analysts and reports will probably highlight those points and write their reports accordingly.
First of all, looking at Meta Platforms' cash flow statement, their operating cash flow is increasing so much that even though they are spending a huge amount on capital expenditures, I think they'll be able to maintain it to some extent. Then, for example, investors in NVIDIA could look at Meta's figures and think that NVIDIA's investment value is pretty solid.
Today.
It was very helpful and enjoyable. What do you have prepared for next time?
Yes, now it's the last session on financial statements and also the last session on the cash flow statement. So now I'll explain the meaning of the signs in the cash flow statement and then how the cash flow statement changes from early stage companies to growth stage companies. I'll also talk about how to identify growth stocks at the right time and key investment points related to cash flow. I'll compare these points with real financial statements.
Then next week will be even more interesting. So we're going to look for specific examples where, as you mentioned earlier in today's broadcast, cash flow increases first and net profit increases later, right?
Yes, since we'll be doing a live broadcast next week.
That's right, next week. And then the week after that, it'll be our first time doing a live broadcast together. Thank you for gladly agreeing to join us this time. I sent you some stocks yesterday, right? So please don't just look at the stocks I selected positively. Please objectively criticize whether these stocks really have investment value using actual objective indicators and a cool-headed perspective.
I'll prepare well.
Thank you. It's quite late, so you should get some sleep soon. You worked hard again late into the night today.
You worked hard too, Chief Executive Officer. Thank you.
Thank you.
It seems like you ran out of energy at the end.
The start of your dream is important now. Let's plant a hopeful future together. Every day, it grows little by little. Is there excitement blooming in your heart? Let go of your greed. It won't be any different this time either. The result is just a continuation of the process. Even if dark adjustments come, I'm not afraid. I'll hold Miju's hand and move forward, becoming the light for the unseen tomorrow. Let's make happy investments, support each other's dreams, and walk together down this beautiful downhill path. Happy investing, together with Miju, all of us, until the day we boldly retire in the national stock market style, all together.
Thank you.